Well, for more on the U.S. China trade war and its impact on the Chinese mainland and Beijing's response, I'm joined by Simon Lester. He's Associate Director of the Stiefel Center for Trade Policy Studies at the Cato Institute. Welcome to the show.
Thank you.
So let's start by looking at the Chinese data. We saw robust export and foreign trade in July from China. What does that say about the impact of the tariffs so far in China?
I think what it might say is there was a rush to beat the tariffs. You know, these tariffs were announced and scheduled, and traders knew that they were coming. And so, you know, from what we're hearing, there's been a rush on both sides to get your exports, you know, through the border, through customs before those tariffs come into effect. So this might just be a blip on the radar screen here, and it may be that over the next couple months, as the tariffs fully come into force, we'll start to see, you know, the actual impact. We'll see declines in trade.
And as we know, there are several deadlines in place, and some of them may potentially move. So what's your outlook then for the longer term if this does continue?
For the longer term, if we go forward with all the tariffs that have been talked about, you know, so we have $50 billion to be in place by August 23rd, and then another $200 billion announced, and then the suggestions of another $200 billion. These are imports from China to the U.S. If all of those go into effect, I think we're really going to start to see some harm to the U.S. economy, to the global economy, to the Chinese economy. I think, ideally, what most people would like to see is some sort of negotiation taking place to get us out of this trade war. And, you know, hopefully, at a certain point, there will be pushback from constituents in the U.S. and China saying to their governments, hey, you know, can you do something about this? Can you get us out of this? Can you stop playing this game of chicken, which is hurting us all?
Now, we did see that China's global trade surplus continued to shrink last month, but not, obviously, its trade surplus with the U.S. Do you see this in any way perhaps affecting how the U.S. is viewing China when it claims it's an unfair trading country?
I don't think so. I think that the Trump administration has pretty clear views on Chinese trade practices. A blip in the overall Chinese trade surplus with the world or with the United States, I don't think is going to have much impact. I think you have in the Trump administration people who are true believers that China is doing a number of things wrong, and these tariffs are in part designed to correct that.
So let's also look at these narrowing net exports. How do you see those affecting China's economic growth?
Well, I do think that China could feel some pain from all of this. I don't think there's any question that you know, when you impose tariffs and you affect trade in this way, you're going to have, you know, specific harms to producers in the Chinese economy and the U.S. economy. So I do think that if we get to certain levels, certain amounts of tariffs on a certain amount of goods, then I think, you know, China's going to, you know, we don't want to predict, it's hard to predict recessions or anything like that, but I do think you're going to see a bit of a downturn in both economies if this lasts for too long.
Now, in China's response to these latest U.S. tariffs, we saw lots of energy and auto products on their retaliatory list. What's the strategy there?
Well, I think the initial strategy was to go after the farmers, which is always, you know, every U.S. trading partner strategy. Let's aggravate the U.S. farmers, and then they'll go to their members of Congress and start protesting. But once you're through that, you run out. You have a limited number of goods you can actually target. So I don't know that there's a particular strategy here, except, all right, we've done the easy stuff that everyone's used to doing, and now we need to think of something else. And, you know, there are only, I think China imports about $130 billion of goods from the U.S. each year. So, you know, you have a limit. At some point, you've just put tariffs on everything. So, you know, was there some specific strategy with liquid natural gas? Well, look, I mean, that's a big constituency. It may have been, they may have had a specific member of Congress in mind by targeting that, but it might also have been, well, what do we do next?
And we know that the U.S. obviously wants to become a major energy exporter as well.
That's right. I mean, certainly it's something that we've talked about a lot here. So, you know, again, it may be to irritate the Trump administration or particular people in the administration or particular business constituencies that support Trump.
Now, given that now U.S. goods are going to cost more going into China, are there any countries that you see that might perhaps reap the most benefits?
Australia and New Zealand certainly come to mind. They're big agriculture exporters to China. They have free trade agreements with China, so they already have an advantage, a price advantage, because they're paying lower tariffs than others. I think Brazil also, as a soybean exporter, can take the place of some of the U.S. soybean exporters. When you get into industrial goods, I think there are European companies who are probably eyeing some new opportunities there. You know, there's a constant battle between Airbus and Boeing for selling airplanes around the world, and if Boeing ends up caught in this, I'm sure Airbus will be happy to step in and take some sales from them.
Certainly a lot of maneuvering to be had. Thank you so much, as always, Simon Lester there, Associate Director of the Cato's Herbert A. Stiefel Center for Trade Policy Studies.